Hi, good afternoon, everyone. Thank you so much for joining us at our last event from 2022. Today we'll ending the year on a really nice note, talking a little bit more about the tax strategies and what is the best way gifting to charities. As you all know, here at United Macedonian Diaspora, we're always looking for ways to end strong. So this year with our end of year campaign, we're looking for $50,000, hopefully in the next month. So I'm really hoping we'll finish this year strong. Here with me today, we will be joined by David Fischer and Robert Linskey. They both work with Putnam Investment, and they will be talking a little bit more on what are some ways and strategies that we can use in the end of this year. So I will pass it on over to David, and please introduce yourselves, and then we can go from there.
Emma, thank you so much. Hello, everybody. It's great to see you today. I'd start with a heartfelt thanks for the time. Thanks for jumping on the call, and kudos to Dean Janceski, my friend and colleague here in Michigan, who was able to connect us with this content to you folks at the Macedonian Foundation. So it's great to be with you. Merry Christmas to everybody and happy holidays and so forth. Putnam is very proud to work exclusively with financial advisors across the country, including those at Merrill Lynch, where Dean, I know your contact is proudly employed and does some terrific work. And I am thrilled to be able to work with those advisors across the state of Michigan. We at Putnam are committed to the advancement of their ability to serve their clients' financial planning needs first and foremost, and also their investment planning needs from the mutual fund and asset management side of things. But in that charter, we are really empowered with some terrific members of our team, including Bobby Linskey today, who's joining us, going to kind of be our keynote. Bobby's a lead wealth management specialist. What does that mean? He spends 100% of his time all day supporting financial advisors and those of us who represent Putnam across the country to better understand the opportunities in the wealth management and financial planning landscape. And there's been so much to talk about with the midterm election that just passed. We're in a currently very favorable tax environment, the Tax Cuts and Jobs Act that's still in place. And we thought to really help and empower you guys on the call, everybody on the call here today, Bobby could give some ideas on how to optimize gifting strategies, how to maybe address those of you on the call that are business owners, some unique things to be thinking about as we head into the end of this calendar year, and maybe even look out ahead for 2022, 2023, and so forth. So I just wanted to say thanks you all for the time. Bobby, why don't I hand it over to you, take it away, and thanks for being with us today, live from Boston.
Great. Good afternoon, everybody. Dave, thanks for that introduction. Certainly, thank you for having me on today. As Dave just mentioned, my name is Bobby Linskey, and I am Putnam's lead wealth management specialist. So I spend all my time, frankly, traveling all across the country, meeting with financial advisors like Dean, meeting with shareholders like everybody else on today's call, and really discussing anything pertaining to wealth management. So that could be, the foundational aspects of financial planning around creating a sustainable income stream in retirement. That could be making the right decisions around Social Security, but also paying attention to what's going on in Washington from a legislative standpoint. Does it create opportunities for you to take advantage of? Does it create obstacles that you need to overcome? Or frankly, how can I go about doing the things that I like to do and, managing the money and passing money to my children or donating to my favorite charities? How can I do so in the most efficient manner possible, both from an overall financial plan, but also from a tax standpoint as well, right? Because we always want to make sure that when we're doing something for other people, we're doing it in the best way that benefits us. So what we'll do over the next 20-25 minutes is we'll talk a little bit about some tax strategies in the current landscape. As David just alluded to, we find ourselves in a really favorable environment right now because of the Tax Cuts and Jobs Act. This isn't going to last forever because it is set to sunset at the end of 2025. And with that, let's get going. So as I said, we'll talk a little bit about our current landscape, and then we'll get into some planning considerations. So currently, via the Tax Cuts and Jobs Act, we find ourselves in a really favorable environment. The Tax Cuts and Jobs Act lowered marginal tax rates across the board. So it doesn't matter if you're at the top of the marginal tax thresholds, down the bottom, or somewhere in between, we're all benefiting from these lower marginal rates. So if I make $100,000 and my next door neighbor makes $300,000, we are all paying the exact same amount of taxes on that first $100,000 of income. Additionally, though, the standard deduction was nearly doubled, and then some of our favorite itemized deductions were scaled back. I live in Boston, Massachusetts, so certainly the cap of $10,000 on our state and local taxes is near and dear to my heart. But having said that, we therefore then need to make sure that when we are giving to our favorite charities or really doing anything from a tax standpoint, we are doing so in a really strategic way that allows us to maximize our deductions and at the end of the day, lower what our taxes are. There was something called the Secure Act that passed a couple of years ago. And, that changed strategies around efficiently transferring wealth to the next generation. It did some good things. It increased the required minimum RMD age to age 72. And there's actually a piece of legislation that could potentially be signed by the end of this week called Secure Act 2.0 that would then raise the RMD age to 75. But it also repealed the stretch IRA strategy, meaning that for non-spousal beneficiaries, prior to this piece of legislation, if I inherited an IRA account for my dad, for example, I could take distributions based on my life expectancy. So let's say I inherited a $500,000 IRA. Prior to the Secure Act, I could take distributions based on my life expectancy. I'm 35 years old. My life expectancy factor is probably 45, 50 years of age, meaning that those distributions would be very small at the beginning, allowing that account to grow tax deferred over time, and frankly, provide me a really appealing stream of income over the course of my life. Fast forward to today, I now just have 10 years following the year of the account owner's death to have that account fully distributed. So I have to balance, how do I allow this account to grow tax deferred over these 10 years, but at the same time minimize my tax liabilities? And that's really the struggle that a lot of families are going to have now, is because they've taken away this really efficient way for us to transfer wealth. So now the reason I bring this up is because money is inside of IRAs may be better suited for other endeavors. Maybe it's for charitable giving, or maybe it's just for utilizing that income stream during your own retirement and passing other assets to the children or to your heirs. I just mentioned some of these things as well, but we could see the RMD age increase to 75 via Secure Act 2.0. There's something called the Qualified Charitable Distribution Strategy. We're going to talk about it in just a few minutes. But that has been at $100,000 per year for as long as I can remember. They're going to finally index it for inflation. Additionally, those distributions can only go directly to a qualified charity. And now there would be a one-time gift to a charitable trust or a gift annuity in the sum of $50,000. But once again, some of those numbers could change once the final legislation is passed. But at the end of the day, I think you're probably going to see taxes go higher in the future than they are today. As you can see, there's a number of catalysts that could cause this. The first is, legislation in Washington. Anyone that paid attention to the news the last couple of years obviously saw President Biden's proposal around Build Back Better Act. That didn't come to fruition at the end of the day. Doesn't mean that tax changes cannot happen sometime prior to 2026, which is when the Tax Cuts and Jobs Act expires. So if nothing happens between now and January 1, 2026, we're going to have the Tax Cuts and Jobs Act sunset at the end of 2025. And then the last reason is just fiscal pressure. At the end of the day, our federal deficit continues to grow. 2020 was the highest it had been. In 2021, it was still $2.8 trillion. And at the end of the day, as you can see in the top right-hand corner, 75+% of our annual spending is going towards mandatory programs or just paying down interest. So things like Medicare and Social Security. So it's only 24% that is going to essentially, election spending. Everything else is going towards mandatory programs that needs to be paid down. And that's why we have the issues around Social Security Trust Fund being depleted by 2033, which is certainly a statistic that makes its way around. So, I mentioned President Biden had the Build Back Better Act proposal that was out in the fall of 2021. That was a $6.5 trillion piece of legislation. It never came to fruition. Instead, we had the Inflation Reduction Act be passed. But these were some of the proposals that were included in that piece of legislation. It wanted to increase ordinary income rates. It wanted to increase long-term capital gain rates. It wanted to change around some strategies when it comes to retirement accounts. Luckily, none of these things for the most part came to fruition. Unfortunately, they're also going to increase the cap on your state and local tax deduction. I certainly would have loved to have seen that myself, living in good old Massachusetts here, or as us locals call it, Taxachusetts. But at the end of the day, some of these things could certainly, find their way into legislation down the road. Just because it's, quote unquote dead right now doesn't mean it won't be down the road. So what I always tell, my clients that I work with, if any of things on this screen here would negatively impact you if they came to fruition, talk to your financial advisor, talk to the person that you work with that works on your family's financial plan and say, if X, Y, and Z does happen, what's our plan? What's our course of action? Because you certainly want to have that plan in place prior to changes actually happening, so that all you have to do is, press execute, make those changes versus, all right, this is happening. What do we need to do? You certainly want to have a plan in place ahead of time. So having said that, let's get to the good stuff. Let's get to the meat and bones of this presentation and actually talk about some of these planning strategies. So first and foremost, how do we maximize some of our popular deductions? As I said, the standard deduction's nearly been doubled. For a married couple over the age of 65, their standard deduction is nearly $29,000. So unless you have more than that in itemized deductions, you're just going to take the standard deduction. And with our SALT capped at $10,000, there really aren't that very many itemized deductions left besides your mortgage interest deduction and charitable contributions. So how do you maximize the deductions that you're doing? Additionally, taking advantage of lower tax brackets. And then lastly, we'll talk a little bit about estate planning and working with small business owners. So here's a scenario that comes up all the time. Got a married couple, they're 65 years of age. They don't donate $10,000 every year to their favorite charity. However, they have a $10,000 SALT, they have that $10,000 charitable contribution deduction, and then their mortgage interest deduction is $8,000. So in total, they have $28,000 in itemized deductions. Well, since they're over the age of 65, their standard deduction is $28,700. So even after all that, they're still just taking the standard deduction. That doesn't, so these charitable gifts they make, it doesn't provide them any tax benefit. So the idea is instead is that, all right, well, in year one, instead of giving, 10 grand every year to my favorite charity, in year one, I'm instead going to give $30,000 to my favorite charity. Now I have $30,000 charitable contribution deduction, my $10,000 SALT, and my $8,000 mortgage interest deduction. Now I have $48,000 in itemized deductions. I itemize. The next couple of years, I don't give any money to charity, and I just take the standard deduction. So at the end of the day, this is going to give this potential client here, it's going to give them tax savings. The issue with this is that if I give $30,000 this year to Macedonia Foundation, you guys are going to call me up next year and say, hey, Bobby, we really appreciated, that elevated contribution you gave us last year. Can we expect $30,000 again this year? And unfortunately, I'm saying, no, I gave you 3 years worth of charitable contributions last year. But, just like anybody, you want that steady income stream, right? You have, expenses that you have to meet every year, and you want that more consistent cash flow to manage expectations. So I think the idea here instead is, instead of giving $30,000 that first year to your favorite charity, instead put it into something like a donor advised fund. Those can be set up through a number of different financial institutions. Putnam does not have one, but there's obviously a number of other large companies out there that do. You can just Google donor advised funds. But what happens is I can give that $30,000, put that $30,000 into a donor advised fund in year one. I get the $30,000 charitable contribution deduction up front. But then I can give $10,000 each year to Macedonia Foundation. So I get the benefit up front of the large charitable contribution deduction, but then I can still give them that steady stream of income, which is at the end of the day is probably what they'd rather have than these large lumpy, over the course of every few years types of contributions. The other benefit for yourself is saying, all right, maybe I don't give cash. You could actually give appreciated stock. Maybe you have stock that you've held on to for decades. You don't want to necessarily touch it because your cost basis is so low. And if you sell it, you're going to have to recognize all these capital gains taxes. So let's say I have Amazon stock. I have $50,000 of Amazon stock, but my cost basis is 10 grand. I don't want to touch it because those capital gains taxes I'm going to pay on that $40,000. What I can do in this scenario, put the Amazon stock of 50 grand into the donor advised fund. Now I'm going to get a $50,000 charitable contribution deduction, but I don't have to worry about the capital gains taxes at all because it went into a charitable vehicle. So this is benefiting yourself because you're going to get the much larger upfront deduction, You're not going to have to worry about the capital gains taxes, and then you can make those donations to your favorite charities over a number of years. The other reason that I love donor advised funds is I was down in New Jersey probably 5 or 6 years ago now. I was working with a client, and he was telling me, and I was meeting with a client after a dinner, and he was telling me, oh, Bobby, I'm very philanthropic. It's a really big part of my life. I want my children and grandchildren, you know, to follow in my footsteps and really donate and work with the charities that I've been, you know, so impacted by, but they don't necessarily have the means to do so. So what we talked about is this client, he was in his 80s. He was going to fund a donor advised fund with $100,000 of appreciated stock. I don't remember what the stock was. It was probably like Apple or Amazon, right? And then he was going to allow his children and grandchildren to make donations out of it. So every year when they were all home for the holidays, his grandchildren made him PowerPoint presentations on which charities they wanted to send money to each year. Now, the children got the benefit, or the grandfather got the benefit because he got the large upfront donation, but then it got the next 2 generations of his family involved in philanthropy, which was something that was really important to him. So for anyone, you know, maybe you have kids or you have grandkids that you want to, you know, get passionate about your passions, especially when it comes to charitable giving, I think funding that a donor advised fund and then allowing them to help you choose the charities in which it's going to go to, as long as obviously it includes the Macedonia Foundation, that may be a nice way to get the entire family involved. Another thing, as far as, you know, IRAs go, and we talked about this earlier, is that, you know, they may not be as appealing to pass to that next generation as they used to be. So why not use them for your charitable endeavors? So there's something called a qualified charitable distribution. It allows you, once you turn age 70 and a half, to send up to $100,000 each year directly to a qualified charity. In doing so, you can fulfill your RMD obligation, and you do not have to report that distribution as taxable income. So essentially it's equal to a 100% deduction. So here's the scenario. I'm 72 years old. I have a $75,000 RMD this year. I don't need that money. I have income from other places. That's going to allow me to meet my living expenses. The only thing that this $75,000 RMD is going to do is increase my taxable income and therefore increase my tax liability. So what I do is I call up the custodian where my IRA is kept. Let's just say it's at Putnam. And I say, will you please send $75,000 to Macedonian Foundation? That pre-tax money goes directly to the charity. Uncle Sam does not get any of it at all. Additionally, it fulfills my RMD obligation. So I just lowered my income by essentially $75,000. So this is a great way to really kill 2 birds with 1 stone. You're making donations to your favorite charity, but at the same time, you're lowering your income as well. So I see this as a nice idea, especially I always talk about it for like churches, right? You give $20 in the collection box every single week. Instead of doing that, why not at the end of the year to say, hey, I'm going to have a check sent to you from my IRA for $1,000 or for $5,000 or whatever that money is. But, the charities that you care about the most, do it in a more tax efficient manner that at the end of the day, if it benefits you, you're going to be more willing to give them more money because you're doing so in a more tax efficient manner. So this is a really nice idea. The other thing I'd mention too is we have a client approved piece that goes through this idea. I've worked with individuals in the past that they will essentially take the bullet points from this idea, include it in the newsletter that goes out to your donors, and essentially say, hey, listen, if you're going to give to our charity this year, you have an IRA, this may be a way to, provide more money to the charity and do so in a way that benefits you. The idea being that the foundation will get more and bigger donations and hopefully bring on more donors because they found a way to do so in a more tax efficient manner. We were talking a little bit earlier about tax brackets being favorable right now. IRAs, as we've kind of talked about, have no longer have that same appeal to pass down to the next generation as they have previously. Roth accounts may instead be a more efficient way to pass wealth to that next generation. I gave the example earlier. My dad, leaves me a $500,000 IRA. I have to balance how do I allow it to grow tax deferred, but at the same time minimize my tax liabilities. If he instead passes me a Roth account, well, now I'm just going to let it grow tax-free for those 10 years and take a lump sum distribution at the end. And right now, we're in a really appealing tax bracket today versus where we were or where we will be in 2026. As you can see, the left-hand side is the tax rates and the thresholds today for married couple filing jointly. The right-hand side are the projections for married filing jointly in 2026 when the Tax Cuts and Jobs Act sunsets. I look at this and I say, all right, married couple filing jointly, $260,000 of income. They're in the 24% tax bracket. Fast forward to 2026, they're gonna be in the 33% tax bracket. So if I do a Roth conversion of $70,000, my income's at $330,000, I'm still in the 24% tax bracket. I'm saving 9 cents on every dollar of that conversion doing it today than what it would cost me in 2026. Now I can let that account grow tax-free. The other thing is, unfortunately, we've had a tough year in the markets. I may have had an account that was worth 100 grand in January that's worth 60 or 70 now. Why not do the conversion while the balance is a little bit lower? And then when we see the recovery in the market, now it's taking place within a tax-free account. So I think those are some of the things to think about. And the other idea is that, you know, we talk a lot about diversification. You know, it's important to diversify your investment portfolios. You spread assets among stocks, bonds, cash. You diversify by geography, right? You invest domestically, you invest internationally. We don't talk enough about tax diversification, spreading assets among taxable, like a brokerage account, tax deferred, like my 401k or my IRA, and then tax-free, like my Roth IRA, which allows you to essentially say, depending on the environment that I find myself in, depending on the tax bracket I find myself in, I can make strategic distributions out of one of those accounts based on that information. So just being tax diversified as well, and at the end of the day, taking advantage of the environment we find ourselves in right now. And at the end of the day, Roth accounts are going to be a way to hedge the risk of higher taxes down the road, right? If I do a Roth conversion today, and then when I take the distributions in retirement, when I need the money out of that Roth account, I don't necessarily need to worry about the tax bracket that I'm in because those are all going to be tax-free distributions. The other thing is Roth accounts don't have required minimum distributions out of them as well. So that's going to be beneficial. I know we're running up a little bit on time, so I certainly want to get to some of the stuff around our business owners. So I'm going to skip through some of the estate planning considerations. We've already talked a little bit about the 10-year rule, but here's some of the stuff for small business owners. So via the Tax Cuts and Jobs Act, it created something called Section 199A, or the or the 20% deduction for qualified business income. Essentially, if you have income below certain levels, the income from the small business will receive a 20% deduction. So the easiest example, I work for my own business. I'm a sole proprietor. I have $200,000 of qualified business income. My wife is a W-2 salaried employee somewhere, and she makes $100,000. Combined, we have $300,000 of income. So we're over on this right-hand side. I will receive a 20% deduction on my $200,000 of income. So now, instead of us paying taxes on $300,000, we're going to be paying taxes on $260,000, right? So that's a great deal. Now, what happens as I start to go above some of these phase outs? I want to find ways to bring down my income, right? So I can make deferrals into my retirement account, right? Make sure I'm maxing out my 401k. That'll help. Maybe I'm in a high deductible health plan and I can, you know, make contributions into my HSA, my health savings account, but that's only, you know, $7,000 a year if I'm married. Well, what about charitable contributions, right? That's a great way to start bringing down your income and take advantage of this deduction. So this does go away in 2026. So certainly for business owners that are able to take advantage of it, time's of the essence. Work with your CPA to make sure that they're aware of this as well. The other thing to think about is, you know, setting up retirement plans. You know, maybe, you know, I worked with one client that was actually out on Long Island. And he was a consultant. He was a retired Wall Street guy, and he wanted to set himself up a cash balance plan. He was able to substantially bring down his income by funding this cash balance plan. He was his only employee, so he's essentially just putting money into a different bucket versus, you know, necessarily giving it away. So those are some of the things to think about. How can I manage my income to get myself below these various thresholds so I can take advantage of this 20% deduction? Some other things to think about are net operating losses. This allows, essentially, if you're a business owner or past your business owner, your deductions exceed your income. You have an NOL. You can use an NOL to offset up to 80% of your income. So I have a $200,000 net operating loss. My wife makes $100,000. I can use $80,000 of that NOL to offset our income. Now we're paying taxes on just $20,000, and I carry forward my additional $120,000 NOL into future years. We were talking about Roth conversions earlier. What if I did a $200,000 Roth conversion? Now we have $300,000 of income. I can use all $200,000 of my NOL, and I'm paying taxes essentially on a fraction of what I should be paying, but I just did a large Roth conversion. There's also a number of states, depending on where you live. I live in Massachusetts, as I mentioned. I know we have, but there's 20 plus states that have created a pass-through entity election. Essentially, it is for the SALT workaround strategy. So a C Corp, they can deduct their full SALT, right? Their full state and local taxes at the entity level because they're a C Corp. But I'm a partnership. Myself and a couple other guys, we own a partnership. I'm still subject to the $10,000 SALT. So essentially what the states allow you to do is pay that SALT tax at the entity level. You will pay it at a specific rate, whatever that rate is. Let's say it's 6%. I then receive a tax credit to apply to my individual state tax return. Every state has a different rate. Every state's a little different. Definitely work with your CPA if it makes sense to you. But that's something that is available for business owners. And like I said, a number of states have enacted that in the last couple of years. And then lastly, I've talked with business owners that are talking about converting to a C Corp because of, they're talking about the 3.8 surtax applying to S Corp profits. In 2025, when the Tax Cuts and Jobs Act sunsets and the Section 199A that we just talked about goes away, C Corp rate is going to stay at 21%. So there's all different moving parts. Does it make sense for me to go from S to C or vice versa? But I think there is a lot of various things that are available right now to small business owners, whether it's net operating losses, taking advantage of Section 199A or that 20% qualified business income deduction, or lastly, using NOLs and that SALT workaround strategy. So with that, hopefully, we got some good ideas here related to charitable giving strategies, and most importantly, making sure we're getting, a tax benefit ourselves when we do give to our favorite charities. And if we can do so in the most efficient manner, that allows us to give more money to our favorite charities. If we can do so, like I said, tax efficiently. So with that, thank you very much, Emma, for having us on today. I'm more than happy to take any questions if there are any. But the other thing I'll say too is I know there will probably be people watching the recording of this. I'm an extension of David's team. If there are people that have questions that are looking for an answer, reach out to Dean. He can get in front of Dave, and then we can get you those answers as quickly as possible. So I'm more than happy to help with any follow-up that certainly results from today.
Okay, awesome. Thank you so much, Robert. Just real quick, I know most of our many of our members are in that stage with the estate planning. Do you mind just real quick, just the most important thing, maybe just 1 to 2 minutes, if you can tell us a little bit about estate planning portion?
Yeah, absolutely.
Thank you so much.
Absolutely. So, right now the estate tax exemption is it's $12 million per individual. So married couple filing jointly, as long as their estate is under $24 million, they don't have to worry about estate taxes. Now that number is going to go to about $6.5 million in 2026. So if you kind of find yourself somewhere in between there, you want to make sure that you're taking advantage of this higher exemption and starting to transfer wealth to that next generation. Now, at the end of the day, even if I have $10 million in my estate, I'm below the estate tax exemption, but there's a lot more that goes into estate planning than just avoiding, the death tax. Not to mention, a number of states have state estate taxes. I live in Massachusetts, as I've mentioned a number of times. Ours is $1 million. And once you go over $1 million, it goes back to $1. So if I have $1.2 million in my estate and I die, it's not just that $200,000 that's subject to the Massachusetts state estate tax. It's all $1.2 million. So in that scenario, I want to be strategic, right? I want to make sure I've gifted money to my favorite charities. I want to make sure I pass money to my children, maybe, because I'd rather get that number down below $1 million versus have that 1.2 million subject to the state estate tax. So certainly that's something to be aware of, is the estate tax, but also the state estate taxes. The other thing I would think about is beneficiary planning. We talked a little bit about it earlier. But, there's a lot of families that probably have their assets split up, equally among the children. But based on some of the legislation out there, like the Secure Act, maybe I want to be more strategic. So what if I have two children? One is a school teacher in New Hampshire and one is a banker in New York City. Instead of splitting assets 50-50, I instead may want to say, I'll leave the brokerage accounts and the tax-free accounts to my daughter, who's that banker, makes more money because she's worried about taxes. Instead, I'll leave the tax-deferred accounts to my son, the school teacher in New Hampshire, because those distributions are going to be taxed at a lower rate. So I think working with your financial planner and your advisor is going to be really important to say, how can we make sure we're efficiently transferring wealth to that next generation? And at the end of the day, making sure more money is ending up in the hands of our children or our heirs and less money is going to Uncle Sam. One strategy that's come up a lot is the idea of a charitable remainder trust. I mentioned the Secure Act's been repealed, but a charitable remainder trust, instead I could leave my IRA to that charitable remainder trust. Essentially what that allows me to do is I can have either, it has to be at least 5% go to the beneficiary for a term of up to 20 years, or even for the rest of their life. There's some math that goes into it, so sometimes you're just stuck with that term of 20 years. But essentially, I can have that distribution go to my son for, like I said, term of up to 20 years or for the rest of his life. When that term expires or when my son passes away, whatever is left in that trust goes to my favorite charity. So it's kind of a way for me to kill two birds with one stone. Once again, I'm replicating that stretch payment that was taken away from us via the Secure Act, but then I'm also leaving a lot of money to my favorite charities as well. So that would certainly be something to think about from an estate planning standpoint. But the other thing is just making sure all your documents are in order, right? If there's anything that COVID taught us these last few years, it's, do you have a living will? Do you have a healthcare proxy? Anyone that has children right now that are home for the holidays and they're off at school, make sure that they sign a healthcare proxy. Now, the reason that I say this is because what happened, this really kind of came to light during COVID is, God forbid I find out that my son or daughter is in the hospital. I call up the hospital and I say, little Bobby is there, I can't get a hold of him. What's going on? Because of HIPAA rules, the doctors cannot tell me what is going on with my son. So imagine this happens to a parent during COVID and they're obviously very nervous and they're scared and they can't find out that information. If the child has signed a healthcare proxy, they are able to provide them that information. So I think it's just a great idea. Everyone's home for the holidays. Have them sign the healthcare proxy in the state in which they live, in the state in which they attend school. Each state has their own Google healthcare proxy, Massachusetts, healthcare proxy, Michigan, healthcare proxy, Virginia, Maryland, DC, and they'll come up. And I think that's just a really nice idea at the end of the year.
Perfect. Thank you so much. And we do have a question in the chat, if you don't mind just answering that. I'm not sure if you can see it, but I can definitely read it to you. It says, can you elaborate on donor advised funds and how can a charity like the United Macedonian Diaspora reach out to the DAFs?
Yeah, so donor advised funds are all going to be owned by individuals. So I could have a donor advised fund. Fidelity is the biggest donor advised fund custodian in the country. So I could literally just establish a donor advised fund. It's just like any other account. And I put, $50,000 of stock into it, and then I make my distributions each year. I don't necessarily think there's a way to prospect those donor advised funds because they're essentially just an investment account of individuals. Maybe Fidelity advertises them at a higher level, but I don't believe you have the ability to go, there isn't necessarily like a network of donor advised funds. They're all just a charitable vehicle for individuals to put their money into and then make distributions out of. So unfortunately, it's not a group that you can necessarily reach out to and prospect and work with. It's just a charitable vehicle that allows individuals to more efficiently gift to charities.
And Meadow, I would add, I think being aware of that structure that is available to potentially your donors, if they haven't taken advantage of that particular planning option in their own financial plan, financial setup, it's great to bring this concept to your donor base and say, if you're looking for ways to both maximize your tax benefit in a given year, you can establish a donor advised fund, which will allow you to kind of gift more than the standard deduction. And then you can give gifts. They can give gifts to, say, the foundation, the diaspora. In each given year, they can elect to kind of give their charitable gifts through that particular account as they see fit down the road. Just a great planning tool for you guys to be aware of in general. And I think Dean might have, Dean, I don't know if you're on the call or can speak, but I believe Merrill Lynch offers donor advised fund programs for their clients. Most of the bigger wealth management firms do as well. So just being aware of the fact that potentially your donor base hasn't taken advantage of that tool be something to think about in your future meetings, to bring it up as a unique strategy to help maybe garner gifts to the diaspora.
Yeah, you're exactly right, David. And the same goes with the qualified charitable distribution strategy, right? If I can put this in front of my donors or potential donors and say, listen, you can give more money to this foundation or this charity and do so in a way that's going to benefit you from a tax standpoint. I think that's really the power, right? Is, hey, I'm already giving, X amount of money. Well, you could, but you're doing it in an inefficient manner. Well, maybe you give it via qualified charitable distribution and you can give 2X, and at the same time, it's going to basically cost you the same amount from a tax standpoint because you're doing so now in a much more cost-efficient manner.
Awesome. And those were all the questions, unless we have another one. I think that would be it for this call. Thank you all so much for taking the time, and Dean, thank you so much for putting us in touch with David and Robert. I hope everyone is having great holiday season, and hopefully we will see you all in 2023. Have a good one.
Thanks very much, Emma. Thank you, everybody.
Thank you.
You guys have a wonderful holiday.
Same.
Take care. Thank you, Bobby.